So in the previous video, we covered and we actually built out an entire three-statement financial model for this fictitious company ABC, and we layered an LBO on top of it. In this video, we're going to compute the returns that this fund, this private equity fund that is investing in this company will generate over a course of 5 years, right? So let's go ahead and do that. So I take exit, which is this 2025. What is the exit multiple? It is, we have to go to the previous tab, statement. Exit multiple is 10x, right? Yeah. Exit EBITDA in the year 2025 is 177. EV will be nothing but this into this. Total debt, it's going to be that. It's going to be sum of this, comma this, right? Let's just put some here. Cash. What is the cash amount that we have? This 57. Same formula here, right? Okay. So what is the amount of money that we put in? If we were a private equity fund and we were buying out company ABC in 2020 in rupees, crores, it would be this much, right? This is the amount that we put in, and the rest was raised through debt. So this is the amount of money we put in. Let's convert this into USD. 8 into 10 USD million, right? Yeah, correct. At exit, what are the proceeds? It's going to be this. Be this divided by this 10. Why is this going to be the entire equity amount? Because we own 100% of the company, right? And debt is helping us push our returns up. It's helping us lever our returns, right? That's the reason why we're doing it here and not over here. When we enter, the amount of money that we put in is just 700 and not the entire amount. When we exit, the amount that we will get will be the amount after paying down debt, right? So let's just look at this from a perspective of currency depreciation. So I think I just made a small mistake here. This should be, this is the annual depreciation, right? So this should be this 1 plus 4 raised to 5, right? So 2025 minus 2020. Yep, that's more apt. We've done it here. Now, why am I doing this, right? Like, why am I computing proceeds in USD and INR? So most private equity funds that operate in India will raise the capital from an American entity or a European entity or some entity abroad, right? And that money typically is raised, let's, for the sake of argument, let's say it's been raised in the US. Those are dollars that have been raised in the US that have been transferred to India. And that amount of money has gone into buying out this company ABC, right? And the PE fund will operate this company for the next 5 years. And when they sell this company, remember, this company is based in India, right? You will sell it at this valuation, but you will get the amount in rupees, right? In rupees crores. You will not get it in USD. And when that money comes back, a lot of it has to be sent back to the investors, right? In the US, the limited partners. Now, when you send that money back in 2025, you've received it in INR. Once you send it back, you'll have to send it back at the exchange rate, right? At the INR USD exchange rate, which will be different 5 years down the line. And this number of 91 is assuming a 4% annual decline in the rupee versus the dollar. So that's the reason we're doing this. So let's just compute rupee returns. MOIC is nothing but multiple of invested capital, right? So in rupees, you invested these many crores and you got these many back. So this divided by this. And IRR will just be nothing but, because we have no dividends, it's going to be this divided by this. raised to, what's the period? 5 years, right? 1 divided by this minus this minus 1. 1 minute. I think I may have a little bit of a mistake here. Sorry, minus 1 will come outside. Yeah. Right? 2x, 2.1x is 15%, roughly 16%, right? So if I do this plus this, right? If I do this plus this raised to 5, I should get roughly 2.1, which is what I'm getting, right? Alternatively, you can use the rate formula. You can be like rate of period is 5, or the period is number of years is this minus this, PMT 0, present value minus this, future value this, right? It'll give you the same value, 16.3%. So you can do it this way as well. Let's do it. Let's do the same thing in dollars, right? So MYC. Let's move this here. Let's move this here. Right? Let's just do the same thing here. So why is the USD returns lower? Because the currency has depreciated, right? That's why. We have about 12% return versus 16% return in rupees. Now that we've computed returns, right? Let's just run a sensitivity analysis. Now, what is a sensitivity analysis, right? So, one. So what a sensitivity analysis tries to achieve is it tries to tell you, hey man, for the return that you make in terms of IRR and MOIC, right? How do we compute these returns? Basis an exit EBITDA multiple, an exit EBITDA number, and exit net debt assumptions, right? That have come from a model. What this tries to do is it tries to tell us that if these numbers move slightly up or down, right? How would our returns change? That's about it, right? Nothing fancy. Okay, so let's just run this sensitivity, right? So exit year EBITDA, what is our exit year EBITDA? This 177. So let's just right here. Let's say this is 180, this is 190. This is say 170. This is 165. Okay, exit multiple, whatever we assumed. Right? Let's just hard code this value. Some bold. Line. Let's make this 9.5. Let's make this 9. 10.5. Okay. Let's just see for this combination of exit year EBITDAs and this combination of exit year multiples, right? How do my returns change? So currently my US dollar denominated returns are 1.8x in terms of MYC and 11.8% in terms of IRR. So what I do for that is I select this entire rectangle, right? That includes cell Q6 all the way till V11, right? All of this, and I say Alt D and T, and it helps me run a data table. So row input cell will be this, column input cell will be this. Let's just run this, right? So they're all looking the same. Why? Because we need to refresh it. Just press F9. Okay, so it's changed. So refer to this cell, right? Let's just change the color. This cell represents our current returns, right? 1.8x, 11.8. What does that mean? At this EBITDA and this exit multiple, we make this much after 5 years on a US dollar denominated basis. Now, this is a range of returns, right? You can run this on other metrics if you want, like revenue growth or margin. I just chose this because it's like very simple. So the sensitivity here just describes how if my exit EBITDA instead of 177 was like 165 and at an exit multiple of 9x, I would have made 1.4x and 7.2%, right? That's what it's trying to tell you. So hey guys, in this video we covered returns. In the next video we're just going to summarize everything that we did and how a real life LBO, when you do it in a 4-hour case study, might be different from this, and we're going to talk about how it's going to be different. So see you guys there.
Hey, thanks a lot for watching the video. Hope you found it useful and also got a few actionable insights.
Check out our website and join the mailing list for regular content. Do spread the word and share it with anyone else you think might find this useful.